Gentlemen, welcome to our YouTube channel. This is from Money Waves, and we mostly deal on the Elliott wave principles, trending and forecasting for the stock market, index, stocks, and commodities, mostly crude and golds. Now, before we start our video on our channel, I want to tell you that this is not a trading recommendation; it's an educational video. And we are not a SEBI registered analyst. So let's start with our index weekly view, and it's more like an option strategy channel, which I'm going to disclose with you why options buying is important and why it is when it is not good for traders. One of the most short thing is people want to get rich very quickly, and in that process people tend to lose very easily money. So we will be discussing Bank Nifty options buying strategy, and that is a plain simple MA cross strategy, which is moving cross strategy. But before we move to the strategy part, we'll look at what is options, why options pricing is important, and what are the careful factors that you need to look at before doing the options buying. Okay, what is options buying? Options buying is basically we are looking for short-term risk and reward, and which is having good profit potential. Now, if we go for in a risk reward matrix for the options buying, if the risk is high and the reward is high, it's the gambling business. If risk is low and reward is high, you go for it. Now, how we define risk reward, we will talk in the next slide. Now, where to buy? It's always low risk and high reward. That's the best thing you can do if you want to do a plain vanilla options buying strategy. Now, we are not going to discuss any more option selling strategy, plain options buying strategy. Now, there are factors which are affecting the option buying prices. There are two factors which are working always against the option buyers, which is time. So even if the price of the underlying is held, the option will lose its value on daily basis, especially after 15th for the monthly expiry, after 15th for stocks, options, and Tuesday afternoon or Wednesday onwards for weekly option, which is index options mostly. Another thing is volatility that you need to always keep a look at. If volatility during the options buying is very high, a volatility collapse will cause the option prices to deflate. Deflating is simply like a tire has been punctured on the highway, which will not run anymore. So if it is on the high volatility day, if the option prices are trading at like say 500 rupees, it will deflate to like 300 within a second if the volatility collapses. Now, ride the trend, you can win good money. If the only factor that is working in favor of the options buyers is trend. If the trend is in your favor, you try to ride the trend and you can win a good money. Now, there are people who are called market makers. There are also simultaneously who are the sellers. If you are the option buyer, there is a counterparty that are sellers. Now, who are these market makers? Mostly institutionals are option sellers, as time and price, two factors, are favoring them in a market, in a not trending market. So if you know that the prices are stagnant and the underlying stock or index is not moving, somebody is making money while you are watching your position. That is in non-trending markets. So typically that's like for new traders mostly. They are amazed or they are caught unaware that options will lose its value even if the stock did not move by a penny. So I always say only trend is your friend in this market. Okay. Why index options buying? Index primarily refers to Nifty and Bank Nifty. And why? Because Nifty spread, bid and spread. Spread is bid and ask difference. So now if you look at the non-liquid options buying, it is mostly like around 10% for the stocks, and index is around on the range of 0.1 to 2% in a live non-volatile market. So 0.1% is okay, but giving somebody 10% premium over the current prices is very huge amount for options buyers, and it's a disadvantage. So avoid any non-liquid options buying counter like in stocks. If you like, you can trade in Nifty 50 stocks, or index options are best liquid assets to trade in. One of the also good thing is, if you are looking at a spread, look at the value percentage difference. Now options payoff diagram. If a call option expires below the stock price, the options will have zero value. So let's say for expiry, for weekly index expiry, if the index expires on like say 17th, like happened yesterday, if the call options ATM, all the ATM call options and put options will expire at zero value. They will have no value. What is the payoff? Payoff will depend on delta. What is ATM? Let's say 17,500 is strike you bought and 17,500 call is ATM. ITM will be 17,400, 17,100, 200, 300. These all are ATMs. Now for OTM, it's like 17.6, 17.8, 17.9. These are all OTMs, out of money. Now look at the delta figures of OTM 0.123, ITM 0.789 and ATM is 0.5. So always look for the ATM 0.5 for option buying practices. Now options payoff and delta. For example, Bank Nifty is trading at 37,500 and we expect 100 points of move. Theoretical impact is it will give us 50 rupees on a 100 point move. For ATM, for ITM it will give us 90 rupees and for OTM it will give us 20 rupees. Okay. And this is based on 100 rupees premium for each day Bank Nifty options is having at the moment. Due to volatility, the premium might increase from 100 to 150 or 200 rupees. So you should always keep a watch on the volatility of the index. Now, very next day you have to look up for the next ATM. Let's say next day it closes at 37,600. You have to look for 37,600. So 37,600 will be our ATM. Now if Bank Nifty is trading at in a range bound, how will be our payoff? Now if Bank Nifty is trading at 37,500 and did not move for the entire day, in the weekly options the ATM will lose 100 rupees value and at the end of the day it will have a closing value of 400 rupees. ITM will have no move and it will not lose value because it has got intrinsic 0.9 value in this example, and OTM will also lose around 50% of the value or 40% on the day one itself on the opening day, it as index did not move, and this is the favorite for option institution sellers. Now option prices, Bank Nifty option prices have approximately 100 rupees premium for each day for ATM. On Friday, weekly ATM call will have 500 rupees premium or value. This is for normal volatility. If you see something like 500 rupees, 500, 550, that is normal value for the weekly options. Same thing you have to watch for stock prices or monthly index expiries. Now there are other factors, that is gamma and theta and vega, we are not discussing because those things are not relevant here for option buyers. And it is not calculated by us. It is given on the any of the good trading terminal or the websites. The theta and gamma value, which is sometimes during expiry helping the option buyers. Because option sellers don't like volatility, so they will stay away from those periods. Typically, if it's non-trading, the theory here is you should not be in the market. Now, how you will know that the market is not trending, that we will discuss further. And this is the reason why holding options is not good. If for some reason, if you look at this chart, it is very clear impact of option prices. Now for 1 week, if the index does not move and it just moved within a range, what will happen to the ATM, ITM and OTM option prices of the Bank Nifty? The ITM will not lose its value as it did not move. However, the ATM will lose its value slowly, and as the strike did not hit, and the OTM will lose within day 2 or day 3. the ATM will gradually on day 1, day 2, day 3, day 4, it will lose value. At the day 5, at the end of the expiry, if we are buying 37,500 and index is at 37,500, intrinsically it will have a zero value. So it will not give you anything. The only thing that can help you in this market is the ITMs. Now, moving average strategy for intraday. The last part of this video is moving average, what we're gonna discuss as a part of strategy. One of the important things is people look at the higher time frame, but we choose here time frame 3 minutes. So if we are wrong, we will know it quickly that we are wrong on the side, and we can get out quickly. So one thing is risk and another thing is reward. Here we choose moving average, first period is 17, MA2 is 35, VWAP and SMI 15, 5, 6, 10. If MA1 crosses MA2, conditions for entry, and price is above the VWAP and SMI is crossing, the signal line is crossing the zero, we will enter the trade. Now, when we exit? We will exit if SMI crosses the signal or it is leaving the 80. And this is where we are now. Now at the first swing, when we see a swing like this is in the morning, and we wait for our setup. Once the signal goes above, we have a buy signal, we will enter at the crossout and the prices are above VWAP. The red one is 35, the first yellow is your 17 moving average, and the other yellow is VWAP, the very flat line. So we continue it, then we will exit only at the SMI crossover. We will not hold the trade until next day or very next day or any other time frame, or you can simply exit when the MA crosses the other MA, and this is the last. Now in this whole episode you have to look for risk reward. The SL is our previous swing low, which comes around 30 points. Option buying strategy. Now when doing the option buying, we should look for a systemic risk reward. Now if we are risking the 30 points like in the previous slide, we should look for around 45 points or 60 points gain. Now option buying strategy should have an edge to make money in the markets, and this is very important because the markets, we have two factors that are working against the option wire. Now risk for the trade is, if the risk for the trade is coming at a 10% stop loss, look for risk reward or try to exit at 1.5 or 2 times. So if you are making like 15 to 20%, try to exit the position. Now if this position does not work for you for some reason, always respect the stop loss. Trend is my friend. That's the only thing you must remember in these markets. And always remember, two forces are trying to drown you, while one trend is the only one trying to help you out in this whole market. If you are not following or having a system, or if you are not having an edge in your trading style, it is very hard to win in this options buying strategy, because two forces are always acting against you at any point of time. And remember, the more you stay in the market, the more chances that you're gonna lose the premium. If you have any questions about Elliott wave principles, and if you want to learn the forecasting technique or any stock or index query, please write to me at Manu Sohar. We are also associated with Angel One as a channel partner. So you can always call me for stock broking related services or queries. Thank you very much. Have a great day.